Hi, it's Ollie here and welcome back to Get Geek Finance. In the financial world of stock markets, there is a lot of stock market jargon. When I started out investing, I was forever seeing stock market terminology that was completely over my head and I had no idea what it meant. So in this video, I'm going to explain a load of beginner stock market terms in easy to understand language. All of these are essential stock market terms you should know. And even if you're not a beginner, then I'm sure there may be one or two stock market terms you may learn, so I recommend sticking around until the end. All the timestamps are in the description below if you want to jump backwards and forwards or to rewatch a certain part. And if you like this video, then please don't forget to give it a big fat thumbs up and perhaps share it with one of your mates just starting out in the stock market. Also, if you enjoyed this video, then leave us a comment down below to let us know if you'd like to see more of these going forward, as I may make a mini series of these, as there are literally hundreds, if not thousands of stock market terms. But in this first video, I'm going to try and focus on some absolute fundamental stock market terms that you should know. Now, before we get stuck in, I must be clear, I am not a financial advisor and nothing in this video is intended to be financial advice. And if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, and you should know that these are just quick definitions and there is often more to these terms that I won't have time to cover in this video, so please do your own research. So now that's out of the way, let's get stuck into the video. Now, generally, these are in alphabetical order, but I've rejigged one or two, as sometimes you need to know one term to understand the next. So firstly, an analyst. An investment analyst is a financial professional with expertise in evaluating financial and investment information. Often you will see analyst price targets on a stock, and these are what analysts think that a stock price will go to, normally over the period of the next 12 months. Next is an asset. So an asset is a resource with value with the expectation that it will provide a future benefit. So an asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. Some examples of asset classes are stocks, bonds, currencies, commodities, or real estate. So bonds, what is a bond? A bond is simply a loan taken out by a company or government. Instead of going to a bank, the company gets the money from investors who buy its bonds. In exchange for the investment, the company pays an interest coupon, which is the annual interest paid on a bond expressed as a percentage of the face value. Next, what is a bull market or bear market? So these terms are used everywhere amongst investors and it used to confuse the hell out of me. But it's very simple. A bull market is a market going up and prices are rising, and a bear market is when the market is going down and prices are falling. So easy way to remember this is to think of the way that they both attack. So a bull attacks with its horns going up and a bear attacks by swiping its paws down. Similarly, if you're bullish on a stock, you believe that the stock's going to go up. Alternatively, if you're bearish on a stock, you believe that it's going to go down. So next, capital. Now, we're not talking about capital cities here. Capital is a bit of a broad term that can describe anything that has value or benefit to its owner. But capital is more often associated with cash that is being put to work for productive or investment purposes. So what are capital gains? This refers to the increase in value of an asset when you sell it. So a capital gain occurs when you sell an asset for more than what you originally paid for it. And this can be a stock, bond, or real estate. Capital gains are taxable in most countries. So next is CFDs, or the acronym also stands for Contracts for Difference. This is a type of trade where you don't hold the underlying asset, but it's an agreement between you and the broker to settle the difference in the price, replicating the real asset. Because you don't hold the real asset, you can do things that make them a lot more risky, like using leverage, whereby you come along with a certain amount of money, then the broker essentially multiplies that amount, so you could trade a position that is a lot bigger than what you currently have. The majority of people lose money trading these, and they are not recommended unless you are an experienced investor. So next is commodities. Commodities are raw materials. They include natural resources that must be mined or extracted, such as gold, rubber, or oil. But they can also include agricultural products such as corn, wheat, coffee, or sugar. So next is compound interest. This is when your money starts making you more money and your interest starts making you more interest. So hypothetically, say you have $100, then in 1 year you make 20% on that. So you'd finish the year with $120. Then the next year, that $120 makes 20% again. So 20% of 120 is $24. So that would bring the total up to $144 at the end of that second year. And obviously, as years go on, this process could potentially repeat. Obviously, this is a hypothetical example and stocks don't just go up. But if you've got time, I recommend playing around with any compound interest calculator online. You'll see how in like 20 to 30 years, your interest could potentially make way more money than you ever brought to the table. So next is day trading. This is when you trade any number of assets, which could be stocks, Forex, CFDs, or options to name a few, on a daily basis. And you are trying to make money every day by making short-term trades. In contrast to this is investing, where people invest their money for the long term. And investing is the act of allocating money with the expectation of generating a profit over an extended period of time. Obviously, this doesn't always play out, but that's the intent. Next is diversification. This is when you spread your risk, and this can be at many levels. For example, if you're solely investing in stocks, you may invest in some tech, some banks, some energy companies, or maybe some travel stocks. Or you could do this across countries or jurisdictions. So you may invest in some European stocks, maybe some Chinese companies, and then maybe some US companies. Or you may even have some bonds and stocks. Basically, you're following the old saying of not putting all your eggs in one basket, because if you drop that basket, then you lose them all. So the same applies to the stock market. If you put all your money in one stock and it goes down, then you're screwed. So you're doing the equivalent of putting your eggs in lots of baskets, and if you drop one basket, then hopefully the others are okay. Dividends. This is when a company pays out some of its earnings to shareholders as a reward to investors for their investment. Some companies pay them, but others don't, because they would rather reinvest that money to grow the company. So it's normally more established companies that pay dividends, like Coca-Cola or McDonald's, for example. ETFs. So this stands for Exchange Traded Fund. So this is a fund traded on a stock exchange that make them easy to invest in. They are normally a basket of stocks that generally track a stock market index or a theme, like genomics or renewable energy, for example. These can give an investor exposure to all of the stocks inside the ETF by only buying one share of the ETF. So next is fundamental analysis. This is a method of measuring an asset's value by analysing the factors that could influence its price in the future. This form of analysis studies the underlying fundamentals of a company, which is based on financial statements, the future prospect of the business plans, industry trends, as well as external events and influences. So a person may look for a company that has growing revenue and profit over time. Fundamental analysis is one of two main methods of market analysis, with the other being technical analysis. So technical analysis focuses on the price movement of an asset by analysing charts to look for trends or historical patterns to predict where the stock price is going next. In technical analysis, there are lots of indicators that can be added to charts like moving averages to help predict this. Technical analysis doesn't look at a company's financial statements and derives all the information they need to trade from charts. So the next is going long, or the term I'm long on this stock. So going long means you are buying the stock. So being long on a stock means you think the stock price is going to go up. A long position is opposite of a short position. So going short or shorting a stock is when you are betting on the stock going down. So you borrow stock from a broker and sell it on the open market. Then after a period of time, if the price has gone down, then you would buy that stock back on the open market at a lower price to return it to the broker and settle up, hopefully cashing the difference. So say you borrow a share from a broker at $100, you sell it to a buyer on the open market at $100. Say a week later the price goes down to $80, then you would buy that share back, then you would return that share to the broker at $80 and you've made $20 profit. Now you may think this sounds great, but shorting is also very dangerous because prices can move up infinitely. So your losses can exceed your original deposit and you could end up owing your broker. Next is growth stocks. So these are stocks and companies that are expected to grow at a rate higher than the average growth of the market. Next are hedge funds. So these are funds usually invested into by wealthy investors to beat the market. The next term is it's a hold. Often this is used by analysts, or you can use it yourself, and it means if you have a stock already, you're going to carry on holding it, but you're not going to buy any more. But if you're a new investor to this stock, an analyst is suggesting they do not think it's worth buying right now. Analysts will mark stocks as either a buy, a sell, or a hold. So next is an index. So indexes show the overall performance of the market. Now examples of these are the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100. The Dow Jones Industrial Average is a bit of an old index that I would personally say is not as representative as the S&P 500. So in the S&P 500, S&P stands for Standard & Poor, and the S&P 500 is their index of 500 of the largest companies on US exchanges. Another stock market index is the FTSE 100, and this is 100 of the largest companies on the London Stock Exchange. So what's an index fund? So these are funds that track one of the stock market indexes. When they track the index, they do their best to replicate the performance of the index, and statistically, most investors will not be an index fund over time. Next is an IPO, which stands for an initial public offering. This is when a private company is about to go public and list on a stock exchange, where anyone can then buy the shares. The change going from a private company to a public company is the initial public offering. Next is a mutual fund. A mutual fund is a type of investment made up of a pool of money collected from many investors to invest in stocks, bonds, and other assets. These give you diversification, and these are often actively managed by a fund manager, which comes at a cost. So the next is a stock exchange. So a stock exchange is a centralized location where different financial instruments are traded, such as stocks, commodities, and bonds. It acts as a market where stock buyers connect with stock sellers. The Nasdaq, this is a tech-heavy stock exchange, but there is also a Nasdaq index, which is 100 companies listed on this exchange. Another example of a stock exchange is the New York Stock Exchange, or the NYSE, which is the largest stock exchange in the world. So next is an online brokerage. So to invest in stocks, you need an account with a brokerage. Usually you deposit money with the brokerage from your bank. Then through the broker, you buy stocks, bonds, options, or whatever you're trying to invest in. And there are lots of brokerages online, and some are more reliable than others, and they all come with different fees. So it's worth spending some time doing some research. Examples you may have heard of are Robinhood in America, or Interactive Brokers, or eToro, which I have an affiliate link for in the description below. And if you sign up using this, then I will get a kickback, which helps support this channel. So next is a portfolio. So this is a collection of investments. So your portfolio is all the investments you own. So if someone asks if your portfolio is doing well, they're basically asking about all your investments and whether they are up or down. Next is quarterly earnings. So this is where a company publicly declares their earnings every quarter of the year, so you can see how well they are doing or not doing. So the next one is ticker symbol. So every stock on the stock market has a specific set of characters, usually between 1 and 4 characters, which it trades under. And it's just a shorthand way to quickly look them up or trade a stock rather than typing out the whole name. For example, Tesla is TSLA, Microsoft is MSFT, and Ford is just F. So next is value stocks. A value stock is a stock trading at a lower price than what the company's performance may otherwise indicate. For example, you could be buying a stock for $5 when its real value should be $10. So value investing is all about finding a bargain where the company still has great fundamentals. So that's it for this video. Hopefully this has given you a firm basis for beginning to understand some essential stock market terminology. If you enjoyed this video or got any value from it, then please smash the like button. If you've got any questions on this video, then please let us know in the comments below. Let us know if you found this helpful and if you want to see more of these, and if so, would you rather they were longer, shorter? I'd love to know, and I read all your comments. Also, if you want to learn more about personal finance and investing, I have loads of videos on my channel, so I recommend you subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.